Okay, so let's continue from where we left. Let's continue from where we left. Last time we were doing a question, or we wanted to start a question on published accounts. That's what we wanted to do last time. We had highlighted the key points whenever you are to prepare. We had highlighted the key points whenever you are to prepare what we were calling components of a complete set of financial statements for publication. So that we had done last time. But today we have new students who have just joined us because today is a free class. So let me go through very fast, for the sake of the new student, very fast on what we had talked about, so that you at least get something, so that we reconnect together. So this is for the sake of the new students, because today is a free class. Now listen. We said when you are a public company and you are required to prepare published accounts, because that's the topic we are doing, we said, what should you include in a complete set of financial statements? One of the components we said you should include in a complete set of financial statements is what we were calling a statement of profit or loss and other comprehensive incomes. I told you last time, this is what some books will call income statement, others will call it statement of comprehensive income, whatever they are calling it. Now, how do you prepare it for publication purposes? How do you prepare it? I'm not going to the details. I'm not going back to the details of everything because we discussed it last time. Today we want to do a question. But just to remind you very fast, we said, when you are required to prepare an income statement or a statement of profit or loss for purpose of publication, there are some key points you have to remember. One, we said you start with the sales as normal, get the cost of sales, and I told you for the cost of sales, you calculate it somewhere. You don't show it on the face of the income statement. No. Calculate that amount elsewhere, bring it as a single amount. We said you get the GP, then you bring in the admin expenses. That's what we said. And I told you again, when it comes to expenses, for the admin expenses, go and combine all your admin expenses somewhere as a working and bring them as a single amount. Bring it as a single amount in the income statement. But otherwise, you combine all your expenses which are of administration in nature. Don't show them individually on the face of the income statement. No. Same we did for selling and distribution expenses. Selling and distribution expenses. Again, I told you, you combine them somewhere. Take all your selling and distribution expenses, combine them somewhere as a working, and bring it again as a single amount. I hope you remember that. Then from there, we said you get what we normally call profit from operations. Get what we were calling profit from operations. Then from there, we said you come and charge what we were calling finance costs. And we gave two examples of finance costs. One of them is what we were calling the interest expense. And how to calculate it, we went through it in details. I am not going to repeat it now, but we went through in the computation of the interest charge in details. The second example of a finance cost is what we called preference dividends. But we said it's not just on any preference shares. I hope you still remember. We said for preference dividends, the ones that should be considered as a finance cost, we said they are the dividends that are unredeemable. Redeemable preference shares, unredeemable, not non-redeemable. Listen, I told you, if your company has paid dividends on non-redeemable preference shares, those ones should be considered as an appropriation of profit. But if your company has paid preference dividends on redeemable preference shares, that we said it should be considered as a finance cost. We looked at the details as to why, which one should be treated where. We discussed the details because of the obligation, whatever. You remember that argument. We don't have to go back now. Just to remind you, I've told you. Today I'm just reminding you. Then we said from there, you come to what we call investment income. As I told you, investment income could be in form of dividends received or interest received. Get the net amount. Then once you do that, you now come and get what we call profit before tax. Then we said you come and minus the tax, you come and minus the tax expense. To get the tax expense, we said there are two components. One could be the current tax, or what some questions could call corporation tax. Then we said you adjust it with the deferred tax amount, the charge for deferred tax. As far as deferred tax is concerned, I told you last time, it is either you will add that charge to the current tax or you will minus that charge from the current tax. It depends with the question. We discussed a lot of ways in which the examiner can test you concerning deferred tax and whether to add or to subtract. I do hope you still remember that. We don't have to go back into the details. You can refer to the previous video that we did last time. Good. After you get the tax expense for the year, we said you now come and deduct. Once you deduct it, now you get the profit after tax. Now you get what we are calling profit after tax. I hope you remember. Listen, we said when it comes to income statement for publication purposes, we said once you get the profit after tax, you don't do the appropriations in the income statement. I hope you remember. We said you don't do the appropriations in the income statement. Where do you do the appropriations of profit? We said the appropriations of profit are normally done in the statement of changes in equity. Of course, you remember. Then I told you, once you get the profit after tax, that is the end. Listen, that is the end of the income statement. Then, if the question tells you to prepare a statement of profit and loss and other comprehensive incomes, that's when we said you now bring in the other comprehensive incomes. We gave examples of comprehensive incomes, and one of them was the gain on revaluation of fixed assets. The other one we gave an example was the exchange difference on translation of foreign currency transactions. I don't have to go back to the details, no. After that, we finished the concern of the income statement. We looked at how to treat debenture interest. You can see there, that's what we did. From there, we looked at, again, another way the interest could be tested. I don't have to go back. Of course, you just need to remember. Then we talked about how to treat preference shares. You can see there how to treat preference shares, whether redeemable or non-redeemable. I don't have to go back into the details. Of course, I just needed you to remember, or I need you to remember, we said redeemable preference shares normally go to the balance sheet or to your statement of financial position as a liability. That's another thing I wanted you to remember, that the preference dividends, the preference shares If they are redeemable, you don't take them to the balance sheet as a component of equity. No. We said you take them to the balance sheet as a long-term liability. Why? I told you last time, it's because as a company, when you issue redeemable preference shares, you have an obligation to pay back. You have an obligation to pay back. We discussed again in details. I don't have to go back into the details. Then, of course, we said if your company issued a non-redeemable preference share, then that kind of share should be considered as a component of equity in the balance sheet. Then I told you the dividend on that preference share now should be considered as an appropriation of profit. Good. You can even see here, we have shown like if you are preparing the balance sheet, among the long-term liabilities, you could have debentures, you could have redeemable preference shares, redeemable. Then I can see it's like we showed when you have to show the balance sheet again, among the equities, you could show ordinary share capital, share premium, and among them, you could have the non-redeemable preference share as a component of what? As a component of equity. Then I can see how to compute preference dividends, whatever we did. We discussed all that. And deferred tax, that does not again. And deferred tax, we don't have to go back into the details. Balance sheet, of course, I do hope you remember. How do you prepare balance sheet for publication purposes? Listen, we said to prepare balance sheet for publication purposes, we said you don't show the fixed assets individually in the balance sheet. In other words, don't come and show the value of machinery, motor vehicle, furniture, building, land. No, don't show them individually in the balance sheet. Instead, we said when it's a balance sheet for publication purposes, we said show a single amount. In other words, compute or add all your fixed assets somewhere. Those assets that normally comprise property, plant, and equipment, which normally comprise property, plant, and equipment, then bring them as a single amount in the balance sheet or in the statement of financial position under the name of what we were calling property, plant, and equipment. You combine all your fixed assets somewhere, machinery, motor vehicle, furniture, building, and so on. Bring them as a single amount in the balance sheet under the name of property, plant, and equipment. Then we said, if there is any other fixed asset that does not qualify to be part of the property, plant, and equipment, that's when we said those ones now you can show them individually in the balance sheet. And we said in most cases these others are always in form of intangible assets. They are normally in form of intangible assets. You can see we gave examples like goodwill, trademark, copyright, investments, patent rights. Those are other examples of assets which cannot be classified as part of the property, plant, and equipment. Good. From there, we discussed how to prepare the statement of changes in equity. That one we can review when we are preparing it for the question. We can review it later, but we discussed how to prepare that. Of course, we shall review it later as we are doing that. From there, we also discussed From there, we discussed also how to prepare what we called notes to the accounts. Notes to the accounts. That one we can also review it later. But we talked about that, and we had to put down the summary notes. Then we discussed all that. Good. So today we want to do that question of the past paper. That is a question we want to do November 2020. We had read it last time. It's only that because of the new students, maybe we can reread it again. Otherwise, we had read the question. It was November 2020, question number 2. So let me project it so that we read it, then we do the question now. That was the question. It was November 2020. It was question number 2. So let me read it. It says, the following trial balance relates to Tamutamu Limited as at 30th of September 2019. You are given a trial balance, and in that trial balance, you are given revenue, inventory, cost of sales, selling and distribution expenses, admin expenses, interest on loan note, investment income, bank interest, leasehold building, at evaluation on 1st of October 2018. Remember, our current year is 2019. So if you are given the value of the leasehold buildings on 1st of October 2018, that must be the value by the beginning. Then you are told the next one is plant and equipment. You are given the cost and stroke depreciation. Computer equipments, again, you are given cost stroke depreciation. Motor vehicle, again, cost stroke depreciation. Then you have available for sale investment, trade receivables, bank balance, trade payables, deferred tax on 1st October 2018. That must be opening balance. Ordinary shares of 29 each. 8% loan, 10% preference shares, and they are what? We are told in bracket, redeemable. You can see now they are testing on the concept that I've just reminded you, that these ones are redeemable. They are not non-redeemable. Let me roll the question. After that, we are given an next part of the trial balance, revaluation reserve, general reserve, and retained earnings, again on 1st October 2018. Additional information. Number 1, on 31st March 2019, on 31st March 2019, the company made a bonus issue from retained earnings of one new share for every 4 shares in issue at 10 shillings. The transaction is yet to be recorded in the books. The company paid ordinary dividends of 2.2 per share on 31st January 2019 and 2.6 per share on 30th of June 2019. The dividend payments are included in the administrative expenses in the trial balance. I talked about that note last time. I talked about it because I remember we read it, but just for the sake of the new students, let me repeat it. I explain it first before we put down the workings. We are told on 31st March 2019, the company made a bonus issue. And I hope everyone knows, we say bonus shares or bonus issue are extra shares given to existing shareholders free of charge. And this question is telling us that they financed the bonus from the retained earnings. But the basis of issuing the shares was, they are saying, 1 new share for every 4 shares at 10 shillings each. The transaction is yet to be recorded. Then after that, we are given the next paragraph. The company paid ordinary dividends of 2.2 per share on 31st of January 2019. I talked about the dates there. Listen, the first batch of dividend was paid on 31st January 2019. The first paragraph talks about bonus being issued on 31st of March 2019. So the dividend of 2.2 was paid before, was paid before the bonus shares were issued. So it means the 2.2 are being paid, or that dividend is being paid on the old shares before the bonus. Then it goes on to say, and shillings 2.6 per share on 30th of June 2019. 30th of June 2019, it is after the bonus. Bonus was issued on 31st March. So if the company later paid a dividend of 2.6 on 30th of June 2019, then it means that the second batch of dividend was paid on the number of shares after the bonus. Listen, so your responsibility here as a student was to find out what was the total dividend that was paid during the year. We need to know, therefore, how many shares were there before the bonus and how many shares were there after the bonus. Those which were there before the bonus, we paid them at 2.2 per share. Those which are there after the bonus, we paid them at 2.6 per share. Then the last sentence says, dividend payments are included in the administrative expenses in the trial balance. I told you last time that treatment is wrong. Yes, whatever we shall get as the total dividend, this company has treated it as an expense under admin. But don't forget, ordinary dividends are normally not an expense. They are normally an appropriation of profit. So when we shall be doing the income statement for this company, it is obvious we shall have to correct the amount of the administrative expense. What we are given in the trial balance is wrong. Good. So maybe before we even discuss note number 2, let us now do that note number 1 as a working first. Let's do that note number 1 so that we go through one note after the other. So let's discuss that note number 1. I have explained it clearly what they want. They want you to determine the number of shares before bonus, number of shares after bonus. Those before bonus, pay them 2.2. Those after bonus, pay them 2.6. Once you get the total dividends, remove it from the admin. The admin amount is wrong. Good. That's what we want to do now. So let's put it this way now. Come and see a number of shares before bonus. Number of shares before bonus issue. Number of shares before bonus issue. How do we know the number of shares before the bonus? We go back to the balance sheet of the company. We go back to the balance sheet or to the trial balance of the company, and we find out what is the total share capital and what is the par value per share. So let me roll the question. Okay. I hope you can see there, our share capital down there is given ordinary of 29 each. Ordinary of 29 each. They are giving us, the amount is 14,500. Our figures are in thousands, so that must be 500. One share is of 29 par value. Good. So you can even say this, 14.9 million, we divide that by 29. We want to know how many shares did we have before bonus. How many shares did we have before bonus? So let's take that 14,500, or we can even just maintain the figures in thousands. So let's just maintain it in thousands. We just take 14,500, no problem. We divide that by 29. 14,500, we divide that by 29. That looks like exactly 500,000. So let's just put it as 500. Good. Those were the shares before the bonus. But we also need to know those which were there after the bonus. So we need to go back to the question and ask ourselves, what was the basis of issuing these bonus shares? They told us one for every blah, blah, blah. I can't remember. That's what we want to go and find out. Let's check. That note number 1 said what? The note number 1 said, on 31st March 2019, the company made a bonus issue from retained earnings of 1 new share for every 4 shares at 10. Good. So let's issue 1 share for every 4. So come and say here, number of shares issued. Number of shares issued as bonus. Number of shares issued as bonus. They have told us these existing shareholders were given the privilege of owning 1 more share for free for every 4. For every 4, they were getting 1 for free. What about for the 500,000 shares? Our figures are in thousands, so we can just maintain it as 500. This will be 500 times 1. I divide that by 4. So how many more new shares were issued? How many more new shares were issued after? No, as bonus, sorry. How many more shares were issued as bonus? I take that 500, I divide by 4. That looks like 125,000 shares. Those were the shares that were issued as bonus shares. Now you need to know how many were there after the bonus shares. How many shares were there after the bonus shares? So we come and see a number of shares in issue after bonus. Number of shares in issue after bonus. We had originally 500 plus the ones we have now issued of 125. That gives me 625. Sorry, 625. So the number of shares that were there before the bonus, just a minute. $625,000 shares. Good. Now that was the beginning point. Now you can compute the total dividends so that we use it. 1, we shall use it as an appropriation of profit. Don't forget, we said in the statement of changes in equity, this is ordinary, this is not preference. 2, we shall use it to correct the admin expenses. Good. So let's now compute total ordinary dividends. Before the bonus, the company had 500,000 shares, and each share we were paying them at 2.2, if I remember, at 2.2 plus. After the bonus, now the company is no longer having 500,000 shares, but 625,000 shares, and we are paying them at a rate of how much per share? What was the question telling us? 2.6. Good. 2.6. So in total, what will be the amount of the dividend? In total, what will be the amount of the dividend? So it will be 500,000 times 2.2 plus 625,000 times 2.6. That looks like a total dividend of 27.25. Good. So you will remind me when we are computing the true admin expenses to deduct this amount. They included it as an admin, yet the treatment is wrong. Dividends are normally an appropriation of profit, not as an expense. As an appropriation of profit, but not as an expense. Good. So that is it for that note. You will remind me we are not through with it yet, but we have used it to compute what we wanted to compute. We have used it to compute the dividend. Now we can go to note number 2. We see whether there is any workings to be done. We want to see whether there is any workings to be done. That's what we want to see, whether there is any workings to be done. From note number 2, is there any workings to be done? Okay, let's read it. Inasema, interest on loan note and dividends on preference shares are yet to be accounted for. That's not a big deal. You just have to remember that interest on the loan and the preference dividends have not been accounted for in the income statement. How to account for them, we shall be doing it as we are doing the income statement. But that is just an information. How much we shall calculate. Later, we shall also ask ourselves how to treat them. We have not accounted for them. Good. That's all we can say for now as far as note number 2 is concerned. Number 3, revenue includes shillings 8 million on credit. Revenue includes shillings 8 million credit sales made on a sale or return basis. As at 30th September 2019, customers who had not paid for the goods had a right to return 2.6 million of them. Tamtam Limited applies a markup of 30% on all sales. In the past, the company's customers have sometimes returned the goods under this type of agreement. So let me talk about it. I did last time, but because of the fresh students, let me talk about it now. Listen. This company normally sells some of their goods on a basis we call sale or return basis. So they are telling us, under that note number 3, the revenue includes shillings 8 million credit sales. Okay, so out of the total sales, 8 million are credit sales, goods that were sold on credit. But then, these goods, which were sold on credit, were also sold on a basis we call sale or return, meaning a customer could return them anytime. Then they are telling us on 30th September 2019, customers who had not paid for goods had a right to return 2.6 million of them. So it means, listen, out of 8 million, not all of them have issues. It is this 2.6 million that can be returned anytime, which we are told as at 30th September, which is the end of the year. customers who had not paid for the goods had a right to return 2.6 million of them. Tam Limited applied a markup of 30% on all sales. In the past, customers have sometimes returned these goods under this type of arrangement. So I told you this. Let me explain it. When you sell goods as a business on a sale or return business, it means effectively you have not sold. I talked about it last time. Why? I told you, though the goods are with the customer at the end of the year, when you sold them, you took them as a credit sales. That's okay. You debited debtors, you credited sales. But because the customer has a right to return them anytime, does it mean that you can count the 2.6 million as a sale? No. Because he can return them anytime. So we say, listen, the first thing you must do whenever goods are with the customers at the end of the year and they were sold to the customer on a sale or return basis. Remember, the customer has not sold the goods elsewhere. No, he can return them. So can you count as a business? Can you count a sale? No. So because the customer can return them. It's true, when you sold them, you credited sales and you debited debtors. But this customer can return the goods anytime. Listen, so we said the first thing you must do as a company is to reverse. You need to reverse the entry you made when the goods were sold. You reverse the entry you made when you sold the goods. What entry did you make? You debited debtors and you credited sales. That's one part of the issue. Now listen, the second part. This customer can return the goods at any time. Listen, so when you did your stock take at the end of the year, those goods were not in your store as a company. They were not there. They were with the customer. But the customer can return them anytime. So in principle, these goods are yours. And therefore, you should have counted them as part of your closing stock. Though you sold them on sale or return, the customer can return them anytime. And if he had returned them before the year has ended, they would be part of your closing stock. So in other words, we are saying, the figure you are given as closing stock, wherever you are given, that figure is wrong. Why? Because what you did or what you counted as part of your closing stock, you as a company, it is what was in your store. But there are some goods with the customer somewhere which could be returned anytime. Okay? So what you have to do is to increase the value of your closing stock. Because the goods are still yours by the end of the year. But the question is this. Listen. Do you increase your closing stock by 2.6 million? No. 2.6 million was the selling price of the goods. But you know that stocks are always valued at cost, not at selling price. Stocks are always valued at cost, not at selling price. Listen. So what this question wanted you to do is to ask yourself, these goods that we sold for 2.6 million, how much did they cost us? That's why they gave you markup, or I don't know whether it was margin or markup, whatever it was. Good. So that you use it to compute the cost. Once you know the cost of the goods, you will increase your closing stock. The amount to go to the balance sheet as stock will have to be increased. Listen again. It also means when you did not count them as part of your closing stock, listen, the figure you took to the income statement as your cost of sales, that figure is wrong also. We have talked about the amount that will go to the balance sheet as closing stock is wrong. 2, that same closing stock that was wrong is exactly the same closing stock you used to determine the cost of sales. Don't forget, we normally get the cost of sales by taking opening stock, add purchases, less closing stock. And therefore, that closing stock being wrong, automatically it tells me even your cost of sales was wrong. Again, not with the 2.6, because cost of sales, we normally compute using cost. That's why we call it cost of goods sold. So we shall correct the cost of goods sold with the cost of that stock. So in other words, we are trying to say, listen, your closing stock is undercosted. The one you computed by the end of the year in your company, that closing stock is undercosted. So you will increase your closing stock by whatever the cost, that will go to the balance sheet. At the same time, this closing stock that was undercosted affected the cost of sales. So we want to also conclude and find out, when closing stock is undercosted, what effect did that have on the cost of sales? What effect did that have on the cost of sales? In other words, did it make your cost of sales less than it should be or more than it should be when closing stock is undercosted? Listen, it is obvious you can conclude. You normally take opening stock, you normally add purchases. You get what we call goods available for sale. Once you get the goods available for sale, you normally deduct closing stock. So this company deducted a smaller closing stock, a smaller amount of the closing stock. When they deducted a smaller amount of the closing stock, it means they were left with a bigger cost of sales. Are you getting? Opening stock, add purchases, get the goods available. From the goods available, you normally deduct closing stock. The closing stock we initially deducted was undercosted. It is less. So you deducted a small amount. That means the cost of sales that you are left with after that is a big amount. So our cost of sales is overcosted. I hope you are getting. It is overcosted. You can even look at an illustration by saying, if your opening stock is 5 and your purchases are 10, that gives you 15. If your closing stock is 3, that gives you your cost of sales as 12. But our closing stock is undercosted. Our closing stock is undercosted. We have used 3 because the goods were not part of the counting. So everything else remaining the same. Opening stock, let it be 5. Purchases, let it be 10. That will give me 15. You now minus closing stock. Now assume it's 4. Assuming closing stock is now the right one, 4. That means the cost of sales should be 11. So when we have undercosted, when closing stock is undercosted, we can see that the cost of sales is overcosted. That's what we shall do. So we shall reduce our cost of sales by whatever is the amount of the cost. Good. Now, having understood that, the issue now is, how do we calculate the cost? But before we calculate the cost, let's put down the reversal entry for the sale. So andika somewhere, we are dealing with note number what? Let me just remind you so that when you are revising, you know, we are dealing with note number 3. We are dealing with note number 3. So you can put down somewhere, note 3. Which you are calling it goods sold on return basis. Goods sold on return basis. Good. Then you can say this below that. You can say this below that. First reverse. You can put it down just to remind you when you're revising. First reverse. First reverse the entry made. First reverse the entry made when the goods were sold. First reverse the entry made when the goods were sold. So you come and say debit sales. Remember, when you sold, you credited. Now you are reversing. 2, when you sold on credit, you debited debtors. Now you want to reverse. So we are saying you credit debtors by how much? 2.6 million. Our figures are in thousands, so we are using it 2,600. That way we have reversed. I hope you are following. That way we have reversed. Good. We go on now. Having reversed that entry, now we want to know the cost of these goods. We were given the markup as what percentage? Let me check. 30% markup. 30% markup. Now listen. From your accounting knowledge, if I want to get the cost of this 2.6 million, I just need to know the profit in that and I remove it. If I remove the profit from the 2.6 million, that automatically will leave me with the cost. Because 2.6 million is the selling price. What is the profit loading in that 2.6? That's what we want to know. Listen. Can I take 30% of 2.6 to get the profit? Of course, you know the answer is no. You can't do that. You can't take 30% of the 2.6 to get the profit in the 2.6. Why? We have done branch accounts, you remember? And in the branch accounts, we discuss things like markup and margin. So now listen. There is no way you can take 30% of 2.6. Why? You know, even without the topic of branch accounts, you know from your accounting knowledge, markup is gross profit divided by what? By cost of sales. Markup is gross profit divided by cost of sales. So if your markup is 30%, I can't use it because I don't know the gross profit and I don't know the cost. So if I use 30%, that would leave me with two unknowns. What I know is the selling price. I don't know the cost. And markup is GP divided by cost. So it is obvious. Listen now. The examiner for this question wanted you to convert this markup to something that goes with the selling price. And that which goes with the selling price is what we call the margin. So if I am able to know the margin of the company, and I'm able to know the selling price of the company, then I'm able to know the profit. Why? Because margin, you know from your accounting, margin is GP divided by sales. So if I'm able to get the margin of the company, Then I'll be able to know, I know the sales already. What I'll be left with is one unknown called the GP. So the examiner here was testing you on how to convert markup to margin. That is not a new relationship to you, no. You have done that in financial accounting. How to convert markup to margin. And because of that, let me just mention it, how you used to convert. If you want to convert markup to margin, we don't need the markup, we need the margin. Listen, you normally take the numerator and maintain it as it is, whatever the amount. Then, that numerator, you will normally either, listen, you will either add it to the denominator or subtract it from the denominator, depending on whether you are converting your markup to margin or margin to markup. Sometimes you are given margin, you don't need it. You need markup. Sometimes you are given markup, you don't need it. You need the margin. So for this question, we were given markup. We did not need it. We needed margin. Why? Because margin is the one that goes with the selling price. Now listen. When you convert or when you're converting markup to margin, we normally take the numerator and add it to the denominator. That will give you the margin. Assuming the examiner had given you the margin of 30 divided by 130, and you did not need the margin. Why? Because maybe in that question, the examiner gave you the cost of sales. So if he gives you margin and he gives you cost of sales, then you don't need the margin. Because you don't know the selling price, you know the cost. So you will be forced to convert your margin, to markup. And I've said, if you are given margin and you don't need it, you want to get the markup, just maintain the numerator as it is. Then take that numerator now and subtract it from the denominator. That will take you to the markup. That is the relationship. I don't have to go into the details because it's something you did in financial accounting, but it is a relationship that you are normally required to know. How to convert markup to margin and margin to markup. The fractions does not matter. It could be you are given a markup of a quarter and you don't need it. You need the margin. It will be margin, don't write even this one, 1 divided by what? You take the numerator, add it to the denominator. You get 1/5. That is your margin. What if you are given margin of maybe 2/5 and you don't need the margin? You need the markup. We have said, take the numerator, maintain it as it is. Then take that same numerator, subtract it from the denominator. 2 minus from 5 leaves me with 3. That's what we're saying. If I was given this markup of 2/3, which is 2/3, and I did not want the markup, I still maintain the numerator, but I take that same numerator and I add it to the denominator. That will give you the margin. I hope I've reminded you that relationship. I've not talked about in details, but there's a lot to talk about, but I hope in an overview, that's what you remember. So for this company, they did not give us the margin. We were given the markup. We did not need the markup. We needed the margin. Now we know the margin. It is 30 divided by 130. Good. Let's continue. Put down that. Then you come and now say here, profit made. Profit made. When you sold the goods at 2.6, at a profit margin of 30 divided by 130, what was the profit you made in the 2.6? It will be 30 divided by 130, multiply that by 2,600. So what profit did you make when you sold the goods to your customers? I take 30, I divide that by 130, I multiply that by 2,600. That is giving me a profit of 600. That is giving us a profit of 600. Good. Now you can determine the cost. The cost would be 2,600. You minus 600. That gives you 2,000. Now you know the cost. So use it to correct wherever went wrong. I've told you, listen, I've told you, our closing stock is undercosted. This guy whom we sold to could return them anytime. And therefore, whatever we used as closing stock in our balance sheet is less. We must increase it by another 2,000. These goods are still ours. They can be returned to us anytime. So you come and debit stocks. We are increasing the value of the stocks by 2,000. Listen carefully. I also have told you a short while ago, the same closing stock of 2,000 was used to get the cost of sales. They took the opening stock, they added purchases, they subtracted whatever closing stock. That closing stock I told you was less. And I saw, or we demonstrated, when closing stock is undercosted, cost of sales is overcosted. So we need to reduce our cost of sales. Listen, any cost is always a debit. So when we have cost of sales is a debit balance item. In fact, in the trial balance, it's always on the debit column. So let's come and reduce our closing stock. And you come and see here, cost of sales. We credit cost of sales. We are reducing our cost of sales by 2,000. We are reducing our cost of sales by 2,000. Below that, you can see this. You can see this. To correct the effect. To correct the effect of closing stock being undercosted. To correct the effect of closing stock being undercosted. Remember, this guy has sold the goods, but they are with the customers. He can return them anytime. So the ones in your store are undercosted. So what is the effect? We are trying to correct the effect of closing stock being undercosted. The stock is less, you increase it. Your cost of sales is more, you reduce it. Good. So that's what we shall do. Listen. When we shall be doing the income statement of this company, it is obvious we shall have to correct their cost of sales. We shall reduce their cost of sales. When we shall be doing the balance sheet of this company, we shall have to increase their stocks by another 2,000. Earlier, I had already told you, when the goods were sold on sale or return basis, actually there was no sale. So I told you, we shall have to reverse the entry. How? By debiting sales. So I have told you, whatever sales we are given in the trial balance, they are wrong. They are more than they should be. Good. Whatever figure we are given for debtors in the trial balance also is wrong. It is more than it should be. We shall have to reduce it by 2.6, not by 2,000, by 2.6. Good. So I've explained the concept under note number 3, where we sold goods on sale or return. Good. So let's go to the next note now. We are trying to analyze every additional information first we see. Good. That's all for note number 3. We go to number 4 now. We go to number 4. Number 4 says, depreciation on property, plant, and equipment is to be provided on the following basis. Plant and equipment, 10% on cost, charged to cost of sales. That's okay. Computer equipment, 25% on cost, charged to administrative expense. That's okay. Motor vehicle expenses are motor vehicle, 25% on reducing balance, charged to selling and distribution. That one, there is not a big deal. We can do it as we are doing the question. When we shall be computing those admin expenses and so on, I told you we shall compute them somewhere. Good. So those ones we can do them as we are doing the question later. Good. That's for number 4. Let me roll the question. We go to number 5. We want to see whether there's any workings to be done. Number 5. Number 5, they're saying, Tamtamu revalues its building at the end of each accounting year. At 30th September 2019, the relevant value to be incorporated in the financial statements was 14.1 million. They are saying, I am repeating, Tamtamu Limited revalues its building at the end, not at the beginning, at the end of each accounting year. As at 30th September 2019, that's the end of the year, the relevant value was to be incorporated. The relevant value to be incorporated in the financial statements is 14.1 million. Another paragraph. The building's remaining useful life as at the beginning of the financial year, 1st October 2018, was 25 million. Tamtamu did not or does not make an annual transfer from revaluation reserve to retained earnings in respect of the realization of the revaluation reserve. That does not affect, because even they're telling us they don't make an adjustment. But let me explain. Let me explain. There are several things there the examiner wants you to do. That's note number 5. We want to discuss note number 5 now. Let me explain it first. Our company has a policy. Our company has a policy of revaluing its buildings at the end of each financial year. And we were told by the question that this company revalued their building by the end of the year at 14.1 million. That's how they revalued the building at the end of the year of 15 million. 14.1. Now, the question is telling us, as at first of the beginning of the year, that asset had a remaining useful life of how many years? Wamesema, second paragraph, note 5, the building had a remaining useful life of 25 years as at 1st of October 2018. Good. So as from here, there are 25 more years to go. Don't write yet. If you go to the trial balance of this company, what are they giving us to be the value of the building? Let me take you to the trial balance now. What is the value of the building? Good. I hope you can see it up there. They are saying leasehold buildings, valuation on 1st of October 2018. Valuation on 1st October 2018 was 14,000, which is 14 million, sorry. 14 million. Here. Listen to this carefully now. Listen to this carefully. If the value of the building by January, let's call it January, was 14 million, and by the end of the year, it was revalued to 14.1 million. Listen, there is no way you can say that there is a gain on revaluation of 100,000. No. That's one thing. So one thing the examiner wants you to know is how much is the gain or loss on revaluation. Listen. If the building was revalued at the beginning of the year at that 14.1, then you could conclude there was a gain of 100,000. If the revaluation was done at the beginning of the year. I hope you are following. But here, you are given the value of the building as at the beginning of the year to be 14 million. Then they revalued it at the end of the year to be 14.1 million. So you can't know the gain or loss on revaluation. Listen carefully. You can't know the gain or loss on revaluation until you know what was the book value, what is the net book value of the building as at the end of the year. The question has told you, as from the beginning of the year, the building had a remaining useful life of 25 years. So, listen, meaning therefore, the examiner wanted you to determine what was the depreciation charge for the current year. In other words, this 14 million that was there by the beginning of the year, it has lost value through depreciation by how much? That's what they want you to test and know. It is obvious our company is using straight line method. So I should take the 14 million, I divide by 25 years, that will give me the depreciation charge per annum. Let me first explain it. It will be 14 million, let me just use it as 14,000. I divide that by 25 years. That means every year your asset is being depreciated by 560. Good. Listen. If it's being depreciated by 560, and by the beginning of the year it was worth 14,000, now it has lost 560, what therefore was the book value of the building as at the end of the year? I take that 14 million, I minus that 560 now, I minus that 560, and that will give me the book value to be 13,440. 13,440. Okay? Now you know, listen carefully. Now you know the fair value to be 14.1 at the end of the year. Now you know the book value at the end of the year. So we can argue by saying, if our asset had a book value of 13,440 at the end of the year, and it was revalued to 14.1, it is obvious there was a gain on revaluation of how much? That's what the question wanted you to know, which means you would take that 14.1, you minus that 13,440. That leaves me with a balance of 660. Listen, that 660 is the gain on revaluation. So this question, not this question, this note wanted to test on two things. One, what will you depreciate this year on the building? You should depreciate it by 560. Two, once you get the depreciation charge for the year, use it to get the book value at the end of the year, which we have got as 13,440. Once you get the book value by the end of the year, compare that with the fair value, 14.1. That will give you the book at the gain or loss on revaluation. Ours is a gain. Good. So let's put down that working. Let's put down that working. That's what the question wanted you to do. That's what the question wanted you to do on how to determine, one, the depreciation charge for the year, and two, the gain or loss on revaluation. So let's put down that working. That is note number 5. You can say determination of the gain stroke loss on revaluation. That's what we are trying to calculate. Determination of the gain or loss on revaluation or building. That's the aim of that note. Good. So we come and say here, depreciation charge per annum. We take the book value that was there by the beginning, 14 million. That's what we have been given. We divide that by the useful life, 25 years. That's what we were told. We have agreed a short while ago that comes to 560. We have just agreed that the value by the beginning was 14 million. We were given that amount in the trial balance. Then we were told by the beginning of the year it had a very remaining useful life of 25 years. So it will lose value by 560 every year. Good. And below that, andika net book value as at the year end. Net book value as at the year end. If the value by the beginning of the year was 14,000, I minus that 560, we have already seen a short while ago that I am remaining with a book value of 13 for 40. That is the net book value as at the year end. Good. Once you know that now, you can compare this 13 for 14 with the fair value. That looks like a gain. So you come and say a gain on revaluation. Gain on revaluation. This will be 14 for 100 minus 13 for 40. We have taken 14,100 because that's the fair value by the end of the year. We minus for 13 for 40. We have just seen a short while ago that was 660. A short while ago. Good. 660. So we are through with that note number 5. 660 will be the gain on revaluation. 560 will be the depreciation charge for the year. Good. Let's go to the next note if you are through. We want to go to the next note. We are trying to analyze the additional information, seeing what we can do for them as a working first. As a working first. That's what we want to do. Okay. Let me go to the next note so that we see what we can do there. Let's go to the next note. We see what we can do there. We are through with note number 5. What about number 6? Number 6 says what? I'm reading it. Number 6 says, the available for sale investments held as at 30th of September 2019, that's the year end, had a fair value of 8.4 million. There was no acquisition or disposal of investments during the year. So that one, they just want you to know whether there's a gain or loss on revaluation. Whether there's a gain or loss on revaluation of the available and how to treat it. That one I can talk about later. So that one we don't have to write down. But from the trial balance, what was the value? If you look at the trial balance up there, we are given available for sale investment as 8.7 million. Or in other words, 8,700 from the trial balance up there. From the additional, we are being told it was revalued to how much? That note number 6, they are saying it was revalued to 8.4. Are you seeing it's a loss on revaluation? This time we have a loss on revaluation. Your book value originally was 8.7 as per the trial balance, but the fair value at the end of the year is 8.4. I will talk about how to treat that loss of 300. I'll talk about it later. That is not a big deal. Good. Let's go to the next note. After note number 6, we go to number 7 now. Number 7 says, in February 2019, Tamtam Limited's internal audit discovered a fraud committed by the company's credit manager, who did not return from a foreign business trip. The outcome of the fraud is that shillings 500,000 of the company's trade receivables have been stolen and are not recoverable. Of this amount, shillings 200,000 relates to the company's trade receivables. No, relate to the year ended 30 September 2018, and the remainder for the current year. Tamtam Limited is not insured against this fraud. Listen, I want to read it again so that you understand it. In February 2019, which is of course part of this year, Tamtam Limited internal audit discovered a fraud committed by who? By the company's credit manager, who did not return from a foreign trip. The outcome of the fraud revealed what? Shillings 500,000 of the company's trade receivables, that means the debtors, has been stolen. Has been stolen. Listen, customers have paid, but their money has been stolen. Of this amount, 200,000 relates to the current year. No, 200,000 relate to last year, and 200,000 was for this year. Now listen. Here is a customer who owed the business 500,000. It seems he had not paid for the last 2 years. When he came and paid 500, 200 was for last year and 300 was for this year. Now, it is obvious, listen carefully, that 500,000 is a loss. That's where we are starting. 500,000 is a loss, which will never be recovered. So it means this year, in our income statement for the current year, we must recognize a loss of 300. 200 was for last year. But this year, 200 was for last year, 300 is for this year. So this year we must recognize a loss of 300 as a bad debt. Okay? What we are saying is this, listen. The customer has paid. It's not that he has not paid. The customer has paid. But you, the credit manager, took the money and went with it. But the customer has paid. If the customer has paid, therefore, we as a company, we can't demand from him. So it is automatic. One thing we must do is to reduce the value of debtors. The problem is not with the customer. The customer has paid. So we must reduce the debtors. Obviously by 500. It's only that part of it was for this year, part of it was for last year. Either way, you must, listen, either way, you must credit debtors. Because the customer has paid. So we as a business, we cannot write him off as a bad debtor. No, he has actually paid. The problem is with us as a company. Our manager took the money and disappeared with it. So this year, in our income statement for this year, listen, we must recognize a loss of how much? 300 for the current year. 200 was for last year. Listen, it means 200 affected the profit, not for the current year, but affects the profit for last year. In other words, 200 should be recognized as a loss for last year, not this year. This year we only recognize a loss of 300. So it is obvious, therefore, what the question wanted you to know, it affects two accounting periods, the current year and last year. For the current year, recognize a loss in your income statement of 300. That's one. The other 200, listen, affected the profit for last year. Listen carefully. We can't go to the books of last year and correct it. But this is what we can do. We know whatever was the retained profit carried down last year automatically became the brought down this year. Whatever was the retained profit carried down last year was wrong. That retained carried down last year automatically became the retained brought down this year. So it means our brought down retained profit is wrong. Because it was wrong last year, but we did not correct it last year. We can't go and correct the books for last year, no. But that profit being wrong last year, it became the brought down this year. So we are saying 200, use it to correct the retained brought down this year. 300, recognize it as a loss this year. Then I've told you, either way, for debtors, it does not matter whether the debtor owes me for the last 2 years or whatever. Debtor's balance is still a debtor's balance. It does not matter how long he has not paid me, still a debtor by the end of the year. Good. So we credit debtors by 500 because the customer has actually paid. We can't demand from the customer. He has actually paid. So our responsibility as a company, we shall follow the manager to recover the money. If we are not able, fine. But in our books, we recognize a loss this year of 300 and at the same time reduce our debtors by 300 for this year. 2, reduce our debtors also last year, which is the same as crediting debtors account and affecting our retained profit last year. Listen, we ask ourselves, last year's expenses were undercosted. They should have recognized a loss, but they never recognized. So it means when expenses are undercosted, everybody knows profit is overcosted. When expenses are undercosted, profit is overcosted. Expenses were less last year, so automatically profit was more than it should be. So we shall reduce the profit for last year by 200. Are you there? Good. So let's put down that information for note number 7 now. Let's put down that information for note number 7. You can see these are things the examiner is testing you. They are not part of published accounts. These are concepts that one should have applied them in the normal general accounting concepts. Otherwise, what we are doing is the topic called published, how to prepare published accounts. But these are things the examiner would test you on your normal general accounting knowledge, Okay, so sema hivi, after that, put it down this way. Out of the shillings 500,000, put it out of the 500,000, just 500, sorry, because our figures are already in thousands. Just say this, out of 500, bad debts, out of 500 bad debts, in bracket fraud, so that you know it's a fraud, out of 500 bad debts, in bracket fraud, close the bracket, 200 was for last year. 200 was for last year, and 300 for the current year. 300 for the current year. Then you come and say here, for the current year, debit, bad debts, that is 300, credit debtors. Remember, the customer has already paid. So we need to reduce what he owes us, because he had already paid. It's only that we disappeared with the money. Good. So we are debiting bad debts, or what you can call fraud. No problem, it's still a loss. Maybe you can put in bracket loss to remind you it is a loss. Good. Then you come and say this, for last year, I have told you, listen, expenses were undercasted last year. And I told you, when expenses are undercasted, profit is overcasted. Profit is overcasted. Therefore, whatever we carried down last year as the retained profit, that profit is more. Listen, profit is always a credit balance. That one I hope you remember, you know that. Profit is always a credit balance. So the profit for last year was overcasted. We need to reduce it. And to reduce a profit, I have already told you profit is always a credit balance. To reduce it, you debit. So we shall come and now debit a retained profit. Retained profit brought down. Remember, it was for last year carried down. Now we are correcting it this year. We debit retained brought down by 200, and we credit debtors by 200. Remember, the customer had already paid. The customer had already paid. Now, this 200, I'm saying it is not affecting the P&L for this year. It's affecting the P&L for last year. We shall talk about that. Don't forget, when we were looking at the statement of changes in equity, when we were looking at how to prepare statement of changes in equity, you remember we talked about brought down. We normally start by bringing down our balances. And one of them that we shall bring down is this retained profit. Good. So that means we are through with that note. The examiner there was testing you on several things. One, customer has paid already. You can't demand from him. You must credit data. Part of the amount affected last year, part of the amount affected this year. That which affected this year, recognize it as a loss for this year. That which affected last year, you can't go to the books for last year, but you can correct the carry down last year, which automatically became the opening this year. Good. So this 200, we shall not correct it in the income statement or in the profit and loss. No. We shall correct it in the statement of changes in equity. Why? Because that's where we normally have a brought down. That's where we normally have a retained brought down. Good. Good. So we are through with that note number 7 for that. It was about the fraud. The examiner was testing you 2 things: how to account for the current year's amount, how to account for last year's amount. Current year, recognize a loss, but the customer has paid, credit data. Last year, don't go to the books for last year, go and correct the retained carry down last year, which is the brought down this year. But still, the customer has paid, you can't continue demanding from him. It's only that he paid it this year, but the amount is for last year. But don't forget, debtors account is always a cumulative account. It is always accumulative. We normally don't close their debtors last year and say now we are starting our debtors fresh this year. No. If you had not paid last year, it became the opening this year. Then if we sold to you more goods this year on credit, we are still increasing your debtors. Good. That's all for note number 7. Let me go to number 8. Number 8, they are saying the income tax payable on the profit for the year ended 30 September 2019 was estimated to be 3.5 million. That's okay. That's what we say is called corporation tax or current tax. Then they are saying an amount of 1.2 million is to be transferred. An amount of 1.2 million is to be transferred to the deferred tax. I talked about that last time. Transfer to, transfer from. Good. So maybe we can open that account called deferred tax. We want to transfer 1.2 million to that account. So make it about 3 lines. Open an account called deferred tax. We normally have to bring down the original bank balance first, the original balance. According to the trial balance, what was the original deferred tax balance? Let's go to the trial balance and find out. From the trial balance, where is the deferred tax? Good. If you look at up there, we look at the trial balance up there, we were given deferred tax on 1st October 2018, and it's on the credit column. I can see the amount is 2.3 million. 2.3 million. Good. Bring it down. 2.3 million. Our figures are in thousands, so we come and see a balance brought down 2,300. They are telling us 1.2 million to be transferred to the deferred tax. To the deferred tax. I told you last time, this being a credit balance, and I'm transferring something to the account, it is obvious, we said, you must go and credit this account. So you should come and credit this account, and you credit here by 1,200, which I told you, you debit P&L account. So you are debiting P&L account and crediting deferred tax. Meaning, by the end of the year, we shall carry down a liability of how much? 2.3 million by the beginning, plus 1.2, we are carrying down a liability of 3.5 million. So 3.5 million will go to the balance sheet. 1.2 million will go to the income statement. They are telling us to transfer 1.2 million to the deferred tax. So the examiner wanted to know, are you going to debit deferred tax or are you going to credit deferred tax? We have agreed and said deferred tax is always a liability, and the liability is always a credit balance. So if this account is always a credit balance, and I'm told to transfer to that account, then I can't debit this account. I must credit. Otherwise, if the examiner had told us 1.2 million to be transferred from the deferred tax, then I would remove it from the 2.3. I would remove it from the 2.3. To remove it from the 2.3, I would have debited deferred tax by 1.2, meaning I would credit P&L. But this question is telling us transfer to the deferred tax. So you credit deferred tax and you go debit P&L account. We shall debit P&L account later when we are doing the income statement. Good. So that's all for step number 8 or note number 8. That's what the examiner wanted to see, how to treat that 1.2 million. We are told to transfer it to the deferred tax. Good. That's all for note number 8. Number 9. Good. So we are through with the workings as per the additional information. Not all the workings, no. So number A, they are telling us to prepare a statement of comprehensive income. B, they are telling us to prepare a statement of changes in equity. And C, they are telling us to prepare a statement of financial position. Now, listen, we can't finish the question because we still have some more workings to do. Which workings are we left with? Let me take you through. Which workings are we left with? Not there. Let me take you to the income statement. Here, we are left with 1. We do not know, listen, we do not know the true cost of sales. That one we have to do as a working. Why are we supposed to correct it? It's true we were given in the trial balance some cost of sales, but don't forget, I told you, there were some goods that were sold on sale or return basis. So obvious, when we sold the goods on credit, effectively we had not sold. So even our sales here, the one I'm given in the trial balance is wrong. We shall have to correct it. The cost of sales we are given in the trial balance again is wrong because of those goods that were sold on sale or return. We have already discussed them. That it's true you sold goods, you credited sales, but have you actually sold? No, because goods could be returned to you anytime. So our sales figure we are given in the trial balance is wrong because of that note which talked about goods being sold or sales or return. I remember it was 2.6 million. Then I told you for the cost of sales, we shall have to correct it by not the 2.6, but by the cost, which was 2 million. For the cost of sales, there is a lot there also to be used. Why? Because we read somewhere we are depreciating the assets and classifying them as a cost of sales. Nothing wrong. So it means we have to calculate the true cost of sales, which there is a lot of workings there. Why? Because if you remember, note number 2 or 3 there, they were telling us to depreciate and put it as a cost of sales. Let me see which one. Yes, you can even see there, note number 4. Depreciation on property, plant and equipment is as follows. Plant and equipment, 10% on cost, charged as cost of sales. So automatically it tells me the figure I'm given as in the trial balance for cost of sales is wrong. Obvious. That's what we are saying. And many other information here, like we have already talked about that sale or return, that was from note number 3. I don't know whether there is any other information affecting cost of sales. We shall look for it later. Good. Fine. So that is what I'm trying to say. So we are not through yet. We shall compute the true cost of sales. We shall compute the true admin. Somewhere they have also told you depreciation to be charged at this and charged to admin. Even for the building, I remember that note. Good. where note number 4, they are saying computer equipments, 25% charge to admin. You can see again. Then motor vehicle, 20% reducing balance, charge to selling and distribution, which means the figures we are given in the trial balance are wrong. You can even see from note number 5, the last sentence, number 5, says, depreciation on building is an administrative expense. When we revalued the buildings to 14.4, I do remember we depreciated them by 560 this year. That 560 is depreciation on building. We shall have to charge it qua admin. So it is obvious, even admin expenses are wrong, selling and distribution expenses are wrong, so we have to calculate them. Good. These are some of the workings we have to do. So for now, I don't have enough time to complete. Now listen. I am now talking to the fresher or new students. To the new students, listen now. To the new students, if you would wish to join us for the normal class now, our financial reporting class, because this is financial reporting, our financial reporting class is always every Tuesday, Thursday, and Friday from 8 p.m. to 10 p.m. I am talking to the new students who have not joined because today it was a free class. Good. That is if you wish to join. So far, we have covered, I think, 3 topics, but we can still give you the videos of those lessons. We can still give you the videos of those 3 lessons. These 3 topics, I am charging 4,000 shillings for the semester. That's what I'm charging. So if you are a financial reporting student and you are interested in the continuation of this topic, the remaining of the syllabus or the remaining of the course with us, then you can call me on 0722 65 8875. If you are interested in joining us, you can call me on 0722 65 8875. We normally accept payments in installments. Okay, that is acceptable. Now, listen. I've told you that you can get the videos of the previous classes, meaning our system is in such a way that even if you miss a class, let's assume on a Friday you have a function and you want to attend, just go and attend, but that does not mean that you will miss the class for that day. No, you can still go back to the group where the link was posted and you get the class that you missed. Alternatively, I could have taught you, but you still feel you want to listen to the video again, go back to the group, click on the link, and then it will give you the video that you would wish to listen again and again. That's a good thing about our system. Okay? That is for financial reporting. Listen, that is for financial reporting. It is Thursday, Tuesday, Thursday, and Friday from 8 p.m. to 10 p.m. in the evening. Again, I've told you the charges are 4,000. If you're interested, call me on that number. Okay? Call me on that number. Now, I also teach advanced financial reporting for your friends who are interested in the advanced financial reporting, which is for the advanced level. Yours is for the intermediate. But for the advanced level, we have early morning classes. And we have evening classes. Our early morning classes starts from 5:30 a.m. to 7 a.m. Again, 3 days a week. Our evening classes, if your friends are interested with the evening classes, they start from 8 p.m. again to 10 p.m. 3 days a week. Again, the same system. If they miss the class, they can't count that they have missed the class. they can still go back and listen to the videos again. Okay, good. I also teach foundations, that is financial accounting or foundation level for your friends who have not yet started accounting and they would want to start. Tell them I'm also teaching financial accounting of the foundation level. That is what used to be section 1. Good. And also the one of ATD. There is an accounting paper for ATD. That same accounting paper is also tested in CS. There is a course called CS, another course called CIFA. All those financial accounting, the introductions are the same. So for your friends who are wishing to start these courses, either financial accounting of foundation or ATD or CS or CIFA, all of them have the same syllabus. Good. So that is it for now. What I would appeal, if you have friends, let them know that we are covering all this. Please go and subscribe to my YouTube channel. Go and subscribe to my YouTube channel. Subscribe to my YouTube channel so that you can be notified whenever I post new videos there. Go and subscribe to my YouTube channel. Of course, the channel is called CPA Joseph Juguna. CPA Joseph Juguna. Okay. I think I'm through with what I wanted to talk about to the new students, what our program is, that we teach financial reporting of this intermediate. I've given you the dates, the cost, and my contact if you want to talk to us. Then I've talked about financial reporting. That is for your friends who would wish to do it and they're doing it. Whatever, they have registered to do advanced. We have early morning classes, which starts from 5:30 to 7, and evening classes, which starts from 8 to 10. Then I've talked about financial accounting of the foundation level, foundation level, ATD level, CIFA, and so on. Then we are saying, please subscribe to my YouTube channel so that you get notification whenever new videos are posted. Otherwise, have a good night. See you next time. Otherwise, have a good night. See you next time. Bye. So, if those who are interested, they are new in this group and are interested, please call me on that number 0722 65 8875. So for those who are going on, let's meet tomorrow. There is a continuation of that class tomorrow where we shall finish what we have just begun today. I think we should be able to finish tomorrow. Then we do something else. Good. Otherwise, have a good night. Good night, everyone. Good night.